you. I need a hate to take it far, make moves. Like somebody trying to take it down, place for. You just scoring mine, that's the bar.
All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, I'm going to talk about option pricing and how market makers work, explaining theta, time decay, and just the overall, even implied volatility. I think this was a really, really, really good conversation. This is from an 11 at 11. So if you don't know, we are live Monday through Friday, 30 minutes before open. It's the first link in the description, and it's pinned on the comments. This is with one of the viewers. They called in. I talked to them. They asked questions, amazing questions, which led to this discussion, a cool analogy. So I thought I would share it with you because a lot of people missed it, and the people who heard it were like, this was amazing. I'm going to go walk through it again. So it was really, really beneficial. I loved it. So check this out. And if you don't know also too, we just launched these new channels to help organize the content here. So if you want to get into real estate and learn about that, we have cult real estate, we got cult music and cult cars. But the difference with all these channels, man, we want you guys to actually send us content as well so we could all put out really the best of everything and source that info. So if you got music, real estate tips, car stuff, just send it in. And yeah, well, enjoy this. And make sure you like the video and subscribe. The cult loves you, baby. You're blessed. Stay blessed. Remain blessed. Let's go. This is what is it's so hard for people to wrap their mind around. It's mind-boggling, right? It's how does the valuation change and change so fast and so quick, and that people are willing to pay money for garbage that it becomes so expensive a minute later, and then vice versa. Something so expensive could just drop instantly.
Yeah.
Like instantly. You won't see that anywhere.
See, and you were explaining like valuation of the calls and puts earlier. I don't really understand how they depreciate so quickly. So like you were talking about the frog trade, but I don't like why would that contract bounce early in the morning and then level out? Would it? I guess is it based on the volatility early in the day, or like how does that work? How do the calls depreciate? I don't know how to phrase that.
I get your question.
Oh, okay.
I just said because I'm trying to think of the best like metaphor or analogy I could give you that would be. I mean, what are you into? I'm trying to think. I don't know. Like some stuff comes to mind. I'm like, I'm
a climber. I'm into sports.
Okay, yeah, there's sport. Okay, we could do. There's two. I was thinking sports betting or going to the club. So
all right, let's do sports betting.
We'll do the sports betting one. It's like, picture this. Have you seen those bets where they say it's like they'll literally say, score this many points by the first half? Have you ever seen a bet like that?
Yeah.
Where it'll literally say the stock is going to move this much, the stock. It'll say the Chargers are going to score 20 points by halftime. And then it's paying out. It'll cost, to bet $50 bet. You'll make a $50 bet to make $100 or whatever it is, right? But now every single minute that goes by in the game, now depending on what matters, right? So imagine right off the bat, the first play of the day, the Chargers get a touchdown off the kickoff. So now they have 7 points, and they just need to get to 20 by the halftime. What is it likely? Is it more or less likely now that the Chargers, that bet will be profitable?
More likely that it's going to be profitable.
Why?
Because they're 6 to 7 points closer to that score 1 minute into the game. So they still have
beautiful
amount of time to reach that, or they have a good amount of time to reach that goal.
So exactly, they're closer to the goal, they're closer to the score, which would be the strike price, but then there's still a lot more time now. So now, so let's say that did happen, right? Chargers, and some people look at it, and guess what happened? Some people are saying, come on, Josh, you know damn well the Chargers ain't scoring on the kickoff. I know, the Chargers suck. So think about that, though. So what would you think the odds of that bet would have been? They were very, very low.
Yeah, okay.
So look at how everybody expects that. That's the market maker. That's the market. Even the market's like, no, these guys suck. That's not going to happen. That's a really cheap contract. But then kick off 1 minute, what do you think happens to that contract price?
Probably doubles in value, or at least gains some value.
It's going to shoot up. It'll be, because now they're like, well, shit, it actually became a little bit more likely.
Okay.
So then now, let's say, then what happens now, next play, the other team gets the ball, and then it's a pick six. And this is all within 3 minutes of the game. So now Chargers have 14 points, right?
Yep.
And they need to get to 21 by halftime. Does it become more or less likely?
Much more likely. They still have 30 minutes to do it in.
Exact. So they have 30 minutes. I love how you said that first now. Because, yes, they're close to the target, but that target is only makes sense in what context? The time.
Yeah,
you see what I'm saying? 20 points means nothing, but the minute we put a time frame, now it means everything.
Okay. All right, I'm following.
So now you're saying, well, yeah, now there's 30 minutes left for them to get one touchdown, and then now on top of that, guess what everyone else is thinking? They already scored 2 touchdowns in 3 minutes. So now what is everybody expecting? Do you expect that will occur now, that the Chargers will hit that bet?
Yeah.
So guess what happens to the price of that contract?
Keep going up.
Oh, it'll go up even more after already going up more, even though it started out as a very low probability. So now, and think about sports betting, as the probability of an event increases, what happens to the reward?
The reward increases?
No, the reward decreases.
Okay.
Yeah, because if you made that play before the kickoff, it was probably a 1 to 100 bet, right? After they score the first touchdown in a minute, well, shit. Now the bookie, they're going to pay 1 to 50 probably.
Okay.
But now they only need one more touchdown with 30 minutes. That's probably going to be a 1 to 5 reward.
Okay.
But
all right, I got you.
And and you know what that relates to in options? That's when the price of the option goes up. If you buy it when it's higher, your break even becomes higher. So it's going to take you, even though you could make the bet at that point, the more probable it is, the more expensive it is, the less reward you're going to get, because there's a good chance it could happen.
Okay, now, so for a contract to expire in the money, does it have to be above your break-even price?
No.
Or no?
The minute it gets above the price.
What's in the money? Is it above $50? So let's say the $50 AMD or $55 AMD contracts. As soon as it's above $55, it's in the money?
This as soon as it hits $55, it's in the money.
It's in the money. Okay.
But now it doesn't mean you broke. So depending on the price you paid for that, that's what's going to determine your break even. That's why that's why option is so crazy. You and I could buy the exact same play, and one of us will win money and one of us will lose.
Okay.
Because so you bought it so cheap, let's say you bought it for $5, but then AMD goes to $55 tomorrow or $50, right? Just like the Chargers scoring with this much time left. Now that same contract is probably going to be going for $50 instead of $5.
Yeah.
So if you bought the call at $5, well, you break even at $55.05. Anything above that, you make more profit. And think about it. You took it when the odds were lower. The event starts to happening. You paid a little bit of amount of money to get in that. Your break even's lower. Therefore, your reward is higher.
Okay. All right, I got you.
But now if I paid 55 cents, well, I won't break even till it goes to 55.50. So now, even though I got the same exact contract as you, I paid more money to get into it because it became increasingly more likely. So even if it does hit 55, you will probably be making more money than I will. But then if it goes to 55.50 by the expiration date, you will make money. You would be up 1,000% because you paid $5 for the contract, and now it's 50 cents in the money. So then each contract will have 50 cents of value. Each $5 turned into 50. You're up 1,000%. Me, I paid $55 for the 50 contract, and now it's just at that 55.50 or whatever. I would break even. I wouldn't make money. I wouldn't lose money. So Now, going back to, because I want to explain that Facebook, how we were looking at it. Let's go back to the Chargers now, right?
Okay.
Two touchdowns, 30 minutes left. They did it within 3 minutes. And now the contract's expensive. It has a high price. So now the game keeps continuing. So next possession, Chargers don't score. Okay?
Okay.
5 minutes goes by now. So there's 8 minutes in the game, 22 left in the half. What, is that contract still going to be expensive?
I mean, I would expect that it would maintain probably the same price, or like be right around there, because they still have a decent amount of time left before expiration. It might have, I guess, it might have depreciated a little bit.
Exactly. It would have probably been, the ratio would be within a certain range. But you're right, because it's still possible, because there's still a lot more time, and they only have a little bit of a way to go. Right? So now 10 more minutes goes by. Chargers don't score again. So now there's only, let's say half of it. Let's say now there's one more quarter. First quarter's over. They didn't score again now. So now what are the odds on that play?
They're decreasing. I mean, they've got less time to make it likely. Or to make that 20 points. Okay.
It's still going to be higher than the first play. The price will be higher than the first time, and then it'll still be higher after the second touchdown. But now the odds and probability of that is going down, because now, even though it's still just as close and the score hasn't moved, just like you see today, what's happening with all these stocks they're getting pinned. So their stocks aren't moving. It just barely, it's right close to where it needs to hit that score. But then what's running out? The time.
Okay.
So now it goes from being this contract that went from $5 to $500. It has all of this. It gets all expensive. But then now what starts moving on, we come in there. Now there's 5 minutes left in the fourth quarter, or the first half, or about to come into the half. 5 minutes left. They still need one more touchdown. What's going to happen to the price of that option? Did it come back down to the first play?
No, because they're still close to scoring, but they don't have to go, the first two touchdowns. It's not going to come all the way back down to the base price, what it began at, but it's still going to come down a little bit, because it's less likely that they're going to score before the half.
Mm-hmm. So take a look. It kind of looks like this Facebook put right here.
Okay.
That put today, think about it. It started low this morning at $1. Then 2 touchdowns. It went up to $350. The stock kept dropping. But then it got closer and closer to closer. They're still there, but as the time started running out, it started losing its value, because even though the stock was low, it now had only the time in the market, because this contract expires today.
And that's what you were trying to do with the Ghetto Witch spread. The Ghetto Witch thing. You wanted to hit it before the pop and then turn it over, right?
Well, exactly. Well, this is the frog. You see? Because this is where, I forgot, I think Lisa was saying, she's like, you better get the Facebook. It's going to turn. You're going to miss it. You're going to miss it. And I said, I'm not going to miss it, because what's going to happen is this contract did the exact same thing. Chargers, look, it started at 16 cents. Chargers score twice. It shoots up to $1.70. Right?
Yeah.
But then as the time starts running out, when the stock price goes up, the stock price comes back up. This is the Chargers not scoring again. And again and again. But now the difference is this contract expires today. So then what starts to occur? The value starts to drop. So even though this contract is close to the money, even though the Chargers are close to hitting that 21 target, they're not there. And it doesn't matter if they're right there, one touchdown away. as time goes down, the odds of that play decrease, right? So what the frog is, this is what I'm saying, what I look for the stock to move in the direction I'm going at, and I wait for the option price to lag behind it. Because you don't need to get it before. So now, 5 minutes left in the half, Chargers have the ball. They need it, so the contract will hold a little bit of value. That's what we saw right there when the first drop, when she was like, you better get it. That was a few minutes left. The Chargers have the ball. The contract's still going for $6, $7, $8. That's pretty expensive because now you're only paying for 2.5 hours of time. So you're saying I'll pay $10 when I could go buy a monthly contract. I paid that much for one of my I paid $10 for my 3-week Bank of America call. You see what I'm saying?
Yeah.
So you're paying $10 for one day. So now the Chargers have the ball, and then as the stock starts coming down, that's them making a drive. So now they get a completion, and now they're getting closer to scoring, right?
Okay.
What's going to happen? The odds are going to start creeping back up again because remember, they're still close to the end zone, but they still not there. And now, how long does that drive take? You see that?
Yeah.
Because
it takes them a long time.
If it takes them long to get into the red zone, if it takes them long enough to get there, well, even though they could get close, the odds are going to start decreasing. And that's what I'm waiting for too. I'm pretty much going to wait before I bet on it. I only want to bet on them. The frog is we're waiting until they're really, really close to hitting the target, their touchdown mark. But then we're not going to buy it until they're in the red zone. Because even when they're in the red zone, all they have to do is hit the touchdown and we win. But at the same time now, we're not going to get in until we don't need a bet when they get the ball 5 minutes earlier. You see what I'm saying? Because then we'll pay more money. We'll pay more money and they could still fail because you're racing against clock. So that's what I was saying with the Facebook. That's why I didn't have FOMO. I didn't have this because I'm just saying even if it starts to come down again, it has to really, really drop. But even by then, the odds will probably be able to get it at the same price or cheaper. And then we'll just get it right there, right before they're about to score. And then that's what we want. That's the frog, and that's what's beautiful about it.
Okay, I understand. That makes a lot more sense as to why my Nike contracts and puts are completely worthless today.
Exactly. And you know what happened? You know what earnings is? Earnings is a big game. Or earnings is usually a favorite, right? It's like you're pretty much betting on Tom Brady. You're betting on the Patriots when you play earnings because they're saying we expect this. It's a big game. The odds are high, but then what happens? You come out the gate and the Chargers score on the Patriots. People are like, what the hell? And then guess what happens though with some of those contracts? Even though you pay a lot and it's expected a lot, let's say the Chargers score on the Patriots off of the kickoff. What are most people going to say?
They're probably not going to do that again.
Exactly. It's a fluke. So the odds might get changed up a little bit, but now what's going to happen after that is more time starts passing. Well, that's a different story. Now they're like, oh, the Chargers aren't going to win, but now as more time starts going away, then it goes from, okay, we had big expectations, we had big earnings expectations, but now as more time comes on, they have their earnings, it's after earnings, and now the stock's moving, and then it's not making a move up or down big, all of the odds are going to just plummet. And that's what happens on earnings. It's because people were paying a big game, a big favorite, because there's a big expectation because they know earnings, something's going to happen.
Yeah.
So then when nothing happens, and then now time runs out, and now there's not enough time for anything to happen, well, the price and the odds go down.
Okay. So are the market makers the one that are making, that are affecting those prices, or does pretty much everybody? So let's say I wasn't the only one that purchased those $107 or $108 call contracts. Does everybody that purchased the $107 or $108 call contracts basically lose that money, or is there?
No, it depends. It depends what price they bought it at.
Okay, fair enough. See? Yeah, yeah. But actually, I guess what I'm saying is, like, is there a way that people are selling it prior to the significant drop in price?
Yeah,
Or
100%. Sometimes, and that's why in that first 10 minutes, sometimes after earnings, it'll make a big move in the morning and you could sell out. Or if you bought it 3 days before the earnings, right, and it started moving up coming into earnings, those contracts would have gone up. You could have sold off on them.
Yeah, so that's been my strategy so far. Is I'm not trying to let anything go to expiration. I'm just trying to take a certain, like, 50 to 100% profit off of it. 100%'s been my target.
I see. For me, I'd like to put it to expiration because I like to take as little as possible. I'm putting in these small amounts, and I want it to be, because I want it to get close to the money and end the thing. That's what we're paying for. And this is what nobody could forecast, is time, right? Yeah. You know, why did that contract, you know, in the Chargers example, why did it hold its value after the first touchdown, even after the second touchdown?
Because they still had plenty of time left to be able to score that before halftime.
It's because anything could happen. That's what I take. Right. That's what I take advantage of. But the only way, like I said, go back to it. If you have a big amount of money, it doesn't make sense to hold till expiration. That's why we like the ghetto spreads. I like to put 10, 20 bucks in. I could ghetto spread it now, get all my money back, and then just hold into expiration, because anything could happen by then. We're paying for time. So if any big news comes out tomorrow, there's this or that, it's going to start shooting everything up. And you never know what is. Some crazy stuff could happen, but this is why people are paying, is for the unknown. And that's the biggest advantage we have. It's literally the importance of time. So you want time, but then again, you have to be able to understand on a contract, okay, should I hold this to expiration or not? But then if you're in a contract and it's in the odds, like think about after the second touchdown and they score really, really fast and the odds shoot up, it may make more sense to sell there than pushing it to expiration. Because even if it does go to expiration and they do end up hitting the target, you might have got paid more when there was still a little bit more uncertainty of what was going to happen. You see? Because after 2 touchdowns in 3 minutes, you think the Chargers are going to have a crazy game and run up the score and that they're going to hit that next possession. But then as time goes through, everyone's like, okay, same old Chargers. You know?
Yeah.
It's the same exact thing.
Okay, I got you. I'm following you. So what happens when a contract goes to expiration and it's in the money? I trade options with Robinhood. Is that something that they automatically exercise and just sell the contract and give me whatever the market value of the price would be? Or like how do they?
Well, I don't know. I think Robinhood sells you out an hour before. If you don't have enough money. But if you have enough money on any brokerage, this is standard practice. When a contract is in the money, it automatically exercises if you do not sell it by expiration. So unless you have to call a broker, or you have to give your broker a do not exercise order. So you have to say, hey, do not exercise this contract if you don't want to exercise it. But if you have enough money to buy the stock, if it ends in the money, then the contract expires. You don't get the value of the contract because it expired. You see what I'm saying?
Yeah.
But you get the shares at that price. So
you would have to buy the shares at that price to have the value. All right. Well, I guess the value that you would have earned from selling those contracts.
You would, yes. And now it all depends, though. So sometimes the contracts might be more, sometimes it might be less. But let's say, the $50 AMDs, if it closes at $51, coming into close before expiration, that contract, if the stock's at 51 and you own the 50, the contract is going to be around 90 cents to $1 because that's how much value it has in it.
Okay.
But now, come to close, if you didn't sell it out for the dollar and take the profit, and it's in the money, your broker's going to exercise you, and then come the next day or that next Monday, you're going to have 100 shares in your portfolio at $50. But then if the stock's still at 51, how much money do you have in value?
Whatever the $100.
Yeah, you're still up $100. Exactly.
Yeah.
So that's why they say that's why options automatically exercise. But now sometimes that's why, let's say you paid a lot for that contract. So if you paid $1 or you paid $100 for that contract, and it was a 55, and then or a 50, and the stock ended at 51, you would not want to exercise that contract because you would just break even. It would just make sense to just sell out that contract and try to get your dollar back or more if you can. But then
that makes sense.
But then if the contract wasn't even worth that dollar, but it should if it's in the money, then you would want to just exercise it. But that's what's going to happen at expiration day. It all depends on if your money. It makes intuitive sense. They'll exercise it if it has value. If not, it won't exercise. But the key is the minute it expires, it loses its value. That's where a lot of people make the mistake because they think the contract could be worth hundreds of dollars on expiration date. And they're like, okay, I'm going to get the shares at this price and the premium. No, you'll just get the shares.
Okay, makes sense.
Yeah, it's good. This is a good lesson so far. I think a lot of people got to learn from. I think you guys are learning more about the frog and theta, and that's what this is. You see what I'm saying? This is theta. You don't need to understand a Greek. You don't need to understand it's very, very intuitive. This is understanding what is pushing and pulling and driving markets. And again, this goes back to what I said, there's a story behind it. So you have to understand how you're reading it. That's why every time you buy an option, you're saying something very specific, right? When you buy an option at this strike price by this date with that much premium, you're saying, I think the stock is going to go to this price by this date. Exactly. Otherwise, you wouldn't buy the contract. You see what I'm saying?
Yeah, I got you.
That's the mistake most people buy because they'll try to buy a cheap contract and not understand that they're explicitly stating with their contract that they believe the stock is going to double in 2 days. You see? Someone will sell you it, but it wouldn't make any sense. You're like, well, that's not what I believe. So that's the key. That's why I say focus on the stock. Try to find what you think the stock is going to do and get an idea of what you think the stock is going to do, and then find an option and a price of the option that reflects exactly that.
All right, I understand. So next question. If you're purchasing something that's out of the money and there's no one else buying it in the market, let's say the limit is from 0 cents to 25 cents. If you put a 5-cent bid on that and the market makers don't fill you, like how do they determine what the fill price would be? Like are those stocks generated, or are those contracts generated from individuals holding that, or like I guess I don't really understand like where do the options contracts originate? Like how is it possible to trade options contracts like this?
That's why they call it a market maker. Those are the computers. Those are the people. Think about the term market maker. They're willing to make a market. So these guys come in here and they use these calculations. It's called the Black-Scholes model to determine. That's even where implied volatility and all that comes from. They're trying to determine a base level of what they think it's worth, and then they do it at a rate because since they're charging a premium, they said we're willing to pretty much buy and sell all securities at this price, and then they set a base level of price that they want to pay for it. And that is their designed to essentially protect them, And then what happens, they set the base level, but now as the stock moves and then as open market, as people come in and start buying and selling it, that actually adds and declines from that value because then they're getting more information. They see what people are willing to pay. So that will make it up and down. But now in your situation where you're saying, well, like, how do they determine what fills it? It's either you could put that, 0 to 25, and if you put a $5 bid, if it doesn't instantly get filled, that means there wasn't somebody, there wasn't an individual or an instant person that was hidden. That sometimes they have orders that you can't really see. The depth, you won't see it fully, and you'll get filled on that. But if it doesn't instantly get filled, no one's there to buy it. And now somebody might see you put up $5, and if an individual is like, oh, that's a really low probability. This guy's an idiot. I'll sell him the contract I'll take his $5 and I'll give him that right. So that's one way. Or if you do put a price and the computer will automatically instantly run a calculation, and if it falls in line with their risk parameters, they'll just instantly take it and fill you. Because they know even depending on how much money they make and this and that, they still have a barrier to where they could make money or at least protect themselves. But if it's instantly, if you're not getting filled anywhere, that means nobody's willing to provide that play, because either you're not offering enough money to make it a risky, to limit their risk, or the stock could move so crazy that even if you're offering way too low for them to even take on that risk, and it wouldn't make sense. So that's what's happening with it. That's why you got to observe them. But I have a video on market makers explaining that when there's news coming out, that's how you could take advantage of it. But that's why too, it's always constantly changing. But it's a mix between the market makers offering a base level, and that's the thing everyone has to understand it as. The market makers are a bank. They don't care. That's why I love it when people are like, oh, the market makers are doing this and doing that. They don't give a shit. Okay, fair enough. It's underwriting. Are you familiar with underwriting?
No, I'm not.
See, someone said take advantage of them. Exactly. That's what you're supposed to do if you understand how they underwrite risk. So like this is what happens when you get a home loan, or a bank, right? Or a car loan. You say, I make this much amount of money, and this is what I'm saying. This operates in every single financial industry in the world. That's why I want you guys to, expand your knowledge in this stuff, banking, real estate, all of it. You go get a car loan. You say, I make this much amount of money. The car is worth this much. This is my income. This is my credit score. They take all of that. And then the bank says, okay, we're going to give it the loan. But before they do that, they send it to underwriting. And the underwriting, that's the people where the bank is pretty much saying they have a certain checklist of risk. It's a risk assessment model to say that you're a risky borrower or a safe borrower. It's a risky bet or it's a safe bet. And they just make sure that it falls in line with safety. So even then, the underwriter, that's why sometimes when it goes to the underwriter, you may not be a good credit borrower. You're risky, so you know what they do? They raise the interest rate. Yeah. They raise the price so that they could collect premium in the event you fail. But then, if it's too risky, they won't underwrite it, and they say, no, we won't fund that loan, because that's them not choosing not to fill it.
And so if you're in that example and you put up collateral, would that reduce the risk of, or I guess would that reduce would that increase their probability of filling that loan if you had collateral put up to it? Like, would it reduce your risk as a borrower, I guess?
Yes, 100%, but that's what banks will do. That's what banks will do. Real estate cars will say, well, can you put more money down? Because now if you put more money down, you're lowering the loan amount, right?
Yeah, I bought a Toyota Prius it's been about a year ago now. The price on it was $10.8K, and I put down, my credit history is kind of terrible, just from stupid stuff that I had to do through college. But I had, there was no way I was getting a loan for the car, just based on my credit history alone, but I had $6,000 available, and I put down on it, and they came back and approved me after having that much money to put down on it.
Yeah, it's because think about what you're doing now. By you putting down $6,000 of the $10,000 the car's worth, that car, Kelly Blue Book, let's say, is $10,000, right?
Yeah.
So now, by you putting down $6,000, the bank is only giving you $4,000, right?
Yeah.
So now, by you putting that money down, the bank is. Do you see why the bank is going to take the deal? And it meets their underwriting, because they're saying, well, even though you have bad credit and you're kind of a riskier borrower, the fact is you have security in the vehicle. So now they're giving you $4,000 for a car that's worth $10,000. So now they're going to charge you even more interest, but the fact is it's less risky on their end, because if you don't pay the bill, what are they going to do?
Come and take it.
They're going to come take the car, sell it for $7,000 and get their money back.
Okay.
So now think about that in an option. And as in an option, this is what we're saying is, why is the option not getting filled? If you put too low of a price and there's no individual out there, so none of the traders are willing to sell premium on it, and you're trying to buy this out the money or even in the money option, and that's why this is literally why when there's volatility, all of the options go to $5, every single one, because
So that's okay.
because they're jacking up the price because they don't know what's going to happen. So
I
by
just had a light bulb moment with, understanding selling puts and selling calls,
Exact-
how those prices get filled. All right.
So now think, in even that example where you're saying it's out the money, they won't fill it. They won't fill it at $5, $20. But now if you offer them $200, $300 for this contract and saying that the stock has to go to this price, not only does it have to go to that price, but you're paying them $300. So you're adding another huge buffer. You see what I'm saying?
Yeah.
So that's why they'll say, okay, it makes sense. I'll underwrite that. It falls within our risk parameter. So even though we may not normally fund this or we don't want to, the fact that this guy's willing to pay a $5 break even, that $500 could protect us $5 either way. It makes it less likely for them to lose. Give this guy the trade. Because then, even if it does shoot up and skyrocket, that $5 helps mitigate their loss in the back end.
Okay.
So,
That makes sense.
so there you go.
I've learned a lot today. I definitely appreciate that.
Yeah, I think a lot of people learned a lot. I think it's a really, really good call, bro. I appreciate it. I think good questions. It's been pretty dope. I like that. Hopefully you guys are learning something. Go watch the market maker video I have, everybody. And now with
I was gonna ask what the title of that was.
I think it's called How I Beat the Market Makers. Because if you watch that video again now with this explanation I gave, this is what makes sense now on the volatility. And that's what I do. That's why when I see volatility, I'm trying to see what the computers. That's why and that's the best part. There's 4 or 5 big market makers. That's 4 or 5 different banks. They're all going to have different underwriting standards, and they're going to all adjust at different times. So I like to see where they're getting fucked up at, and I try to take advantage of them. Or if I could see the depth on the chart and I could find an individual borrower who didn't adjust properly, I'm going to take his bid.
Okay. All right. I follow you.
So go watch that video again, and you guys you'll get your mind blown even more. It's dope. Putting it into context with this.
I'm definitely gonna do that.
Mm-hmm.
Definitely gonna do